Good morning, good afternoon, good evening, wherever you are. I'm David Wu. Welcome to the Money Game, where we make actionable predictions about the big stories shaping the world today. If you're interested in making money, you're in the right place. If you're not, this program is designed for anyone who's just interested in learning about what makes our world tick. Please subscribe at davidunbound.com if you haven't done so already. I want to start the program this week by congratulating the new Lieutenant Governor-elect of Virginia, Winsome Sears, who just became the first black woman to win a statewide office in Virginia. Winsome was born in Jamaica and came to the U.S. at the age of 6. Her father basically arrived in America with just $1.70 in his pocket. She grew up in the Bronx, joined the U.S. Marines as an electrician, and finished a community college degree. Her story is proof that the American dream is still possible regardless of your skin color. In case you don't know, the unexpected Republican sweep in Virginia this week has a lot to do with the rejection of the critical race theory, especially in public schools, by concerned parents across different communities. America has a lot of problems, but I never thought white supremacy is one of them. I became one of the top paid analysts on Wall Street despite my not being white. I have traveled extensively in America and around the world. I can tell you from my personal experience that the United States is one of the least racist countries I know. Apparently, Winsome Sears agrees. On that note, let's turn to this program this week. Continuing on with a theme that I started last week, I want to focus today on what I call the great conundrum. Long-term real interest rates, gave back all their recent gains this week. In fact, they fell back to where they were all-time low only a few weeks ago. My analysis has pretty much ruled out all possible explanations except for two. And these two explanations have reinforced my view that actually you want to look to sell tips and look to buy the US dollar. As I told you last week, long-term US real interest rates are the single most important benchmark for the global financial market against which all asset prices are determined. From that point of view, whether you're investing in bonds, in equities, or for that matter in real estate, you have to first of all decide what is going to be the outlook for US long-term interest rates. And because if you don't, you know what? It might end up biting you in the ass. What makes US long-term real interest rates so important, you may ask? Well, I can give a full course on that question alone, but I'm going to give you a 30-second version of it. First of all, the pricing of all financial assets require a risk-free rate, a rate for, a riskless asset. Number two, the pricing of assets with long-term cash flows like stocks need a long-term risk-free rate to discount their future cash flows into today. Three, because investors are only interested, or should be only interested, in real returns. In other words, after inflation, they should only care about the real risk-free rate. And four, because the US is the largest economy in the world, the US dollar is the reserve currency of the world, and the US financial markets are the biggest, deepest, and most liquid. This means that long-term real US interest rates are like the long-term global real risk-free rates. As I told you last week, 10-year US real yields is currently near its 20-year low, currently around -1%. Because of the world's long-term risk-free rate, is negative and so low, this has been fueling the massive rally that we've seen in stocks and real estate, even in cryptocurrencies. The 10-year US real yield continues descent this week by falling about 8 basis points to -1.1%. This is despite 3 separate pieces of news that should have basically pushed it higher. On Wednesday, the Fed announced that it will soon end its quantitative easing program, In fact, actually it's going to start reducing its bond purchases right away by about $15 billion a month. On Friday, we had a stellar job number out of the US, okay, that would suggest the economy is recovering from the Delta blues associated with the summer. And finally, on Friday, Pfizer announced that it has developed an antiviral pill that reduces hospitalization by 90%. Sliding US long-term real interest rates sent investors piling into risky assets, driving stock markets to all-time high. As you can see here, this is my risk sentiment index is now back to a level associated with great complacency. What's going on here? Are long-term US real interest rates mispriced? Or that I'm losing the plot? To answer this question, let's go back to the drawing board. Let's take a look at the drivers of long-term real interest rates and ask ourselves whether they support the recent decline in long-term real interest rates. The first driver I want to take a look at is long-term real growth outlook. No surprise there that long-term real interest rates ought to reflect the outlook, the forecast, the market's forecast for long-term, basically, growth outlook. So if you're looking at 10-year real interest rates, they ought to reflect basic expectation for real GDP growth over the next 10 years. As you can see on this chart here, in orange, you've got the consensus growth forecast for the next 10 years. In blue, you've got basically long-term, 10-year real yields in the US. And you can see, generally speaking, they've been coming down more or less at the same time over the last 20 years. However, more recently, it's interesting because for 2021, long-term growth outlook, in fact, if anything, has improved. So from that point of view, this driver does not support basically these record low levels of long-term real interest rates. I won't lie to you, the market's long-term growth outlook is heavily influenced by its assessment of the short-term growth outlook. So what about the short-term growth outlook? If we look at the Friday's non-farm payroll numbers for October, they paint a picture that I would argue is almost as good as it can be. If you look at this chart right here, in orange, okay, you have job increases in the private sector outside the leisure and hospitality sector, and you can see job growth has been averaging around 400,000 now for the last 5 months. Very, very steady. And in blue, you've got basically jobs created in the leisure and hospitality sector, and what it shows you is that after the sharp drop in August because of the outbreak of the pandemic, these jobs are slowly coming back as the numbers of new cases basically drops. A more holistic way of looking at the job data is by multiplying total number of jobs by average numbers of hours worked and by average hourly earnings to get the aggregate wage income going to US households. And you can see on this chart right here, aggregate wage income is currently increasing at a rate about 10%, which is actually double the pace before the pandemic. That is pretty amazing if you ask me. As you know, I've been quite concerned about the possibility of a fifth wave of COVID this coming winter and its implications for the global economy and the US economy specifically. Pfizer's news this week is developing an antiviral drug that actually reduces hospitalization by 90%. Obviously has gone a long way to easing my concerns. The fact it's a pill, the fact it's easy to take, I think, especially combined with the third booster, I think the chance that we're going to see protracted shutdown again globally, has definitely receded dramatically. Another major driver of real long-term interest rates is demographics. The idea is that as people get older, they don't want so much risk in their portfolio. They want income, especially as they go into retirement. This is why as people get older, you would expect them to move out of stocks into bonds, and the increased allocation into bonds will tend to basically reduce long-term real interest rates. Okay, and indeed, if you look at this chart right here, it's probable that the decline in real long-term interest rates over the last 20 years has a lot to do with the aging of the American population. But aging is a slow-moving trend. It is difficult to imagine that this has anything to do with the drop in real long-term interest rates that we've seen in the last couple of weeks. Indeed, if you look at basically pension fund flows into U.S. government bonds over the past year, it's increased somewhat, but still the pace of purchases of U.S. Treasury securities by pension funds is definitely not out of the ordinary by any stretch of the imagination. Now let's look at another driver of long-term real interest rates, quantitative easing, the so-called QE. This chart describes how QE actually works. So the government sells bonds to mutual funds and banks in order to raise money to finance its budget, okay? The Fed, the central bank, then essentially engages in quantitative easing by buying bonds from those mutual funds and commercial banks. And their whole objective is trying to suppress long-term interest rates in an attempt to basically inflate asset prices. By the way, you can see this is quite different than printing money insofar that printing money would involve the central bank engaging directly with the government as opposed to doing it indirectly through financial institutions. What you see on this chart here is that in blue, you've got net issuance of Treasury securities, which surged over the last 18 months in order to fund an ever larger and record U.S. budget deficit. In orange, you've got the Fed net purchase of Treasury securities, which also surged as the Fed engaged in aggressive QE in order to drive down long-term real interest rates. But what you can see here also at the same time is that more recently, the pace of Fed net purchases of Treasury securities no longer keeping pace with the size of the net issuance. And in fact, according to the Fed's guidance this week, they're going to be reducing the pace of buying by $15 billion every month in the coming 6 months, which begs the question, who's going to be buying all these Treasury securities once the Fed has stopped buying? Another major driver of long-term real interest rates is the size of the budget deficit. What we got here is a forecast of U.S. budget deficit for the next 10 years done by the Congressional Budget Office. And there are two things I want to basically point out here. Number one, as you can see, this number, after a short dip over the next 2 years, is set to go back up again. In fact, it's going to hit $2 trillion by the end of this decade. That's not that far away, okay? The second thing I want to point out is the fact that for next year, where the Congressional Budget Office is forecasting a budget deficit of about $1 trillion, that does not basically include the infrastructure bill that was passed last week, which still has to be paid for to a great extent, as well as, of course, the social spending bill that's still very much in the pipeline. In other words, there's a very good chance, I think the budget deficit could be as high as maybe $1.5 trillion, if not even higher, for next year, while the Fed is ramping down its bond purchases. The upshot is that the usual suspects that we just looked at are unlikely to be the reasons why long-term real interest rates are so low right now. As I said before, growth outlook is improving. The demographics is a slow-moving basically trend. QE is going to end very soon, and the budget deficit is going to remain very high, all of which will suggest that real interest rates ought to be much higher than where they are right now. So what could be holding down long-term real interest rates? What am I missing here? I'm starting to think that the fallback in long-term real interest rates this week was driven by the fact that Jerome Powell could not have sounded more dovish at his press conference. He said three things that struck a bell with me. Number one, he said that we're not really seeing a tight labor market. The second thing he said was that we don't see troubling increases in wages. The third thing he says that there's still ground to cover to reach maximum employment. Wow. The problem with what he said is that it simply doesn't stack up with the data. As you can see here, wages are now currently growing at the rate of 4.7%, which is the highest rate of growth in more than 10 years. So if that is not troubling to him, I wonder what kind of wage growth he needs to be troubled by it. Is it possible that rapid wage growth is a reflection of rapid productivity growth? Now, if that's true, it's certainly not being borne out by the data because, as you can see here, labor costs, has been accelerating rapidly. In fact, it's growing at a rate of 4%, which is at the highest basically level in 20 years. What about rental inflation, housing inflation, given that rental vacancy is now approaching historic low? I think it's reasonable to assume that rental inflation is set to accelerate strongly in 2022, and that is going to find its way ultimately into core, basically PCE. In fact, if you don't know, housing inflation is more than a third of actually the core inflationary measures that means the most to the Fed. Not to mention the fact it is almost certain we have not yet seen the full effect of the 30% increase in broad money supply over the last 18 months on inflation. Even though Powell is not a trained economist, he has shown that he has good common sense. Okay, this is the reason why I want to give him the benefit of doubt. Now, is it possible that if Powell sounded dovish last week, it was because he knew the next day he was going in for his job interview with the President of the United States? Yes, Powell's term as chairman of the Federal Reserve ends at the end of January, and Biden has to make a decision very soon about who's going to be his nomination. Given Powell was Trump's guy, perhaps Powell felt that he had to impress on Biden that he was going to not put anything basic the economy at risk by taking away the punch bowl earlier than necessary. Now, even the bond market is not taking as a given that Powell is going to get a second term. In fact, if you look at predicted.com, the market is giving Lyle Brainard, a well-known dove backed by the progressives, about a 20% chance. Now, is it possible that somebody, who's privy to the discussion in the White House about, who's going to be Biden's nomination, somehow decides that Lyle Brainard stands a better chance than is priced in and decides to go very long bonds in expectation of a much more dovish Fed under her leadership? You know what? I've seen stranger things in my career. If Biden were to go with Lyle Brainard as his nomination for the next chair of Federal Reserve, I think that would show terrible judgment on his part. And this is because I fail to see how she's going to get through the Senate, especially how she's going to get a vote from Joe Manchin, without whose support it's unlikely she's going to become the next Fed chair. And if you listen to what Joe Manchin has been saying about monetary policy, fiscal policy, and inflation, he's terribly concerned about upside risk to inflation. He thinks fiscal stimulus at this point is inflationary. I would be very surprised he would give his vote to Lyle Brainard. So who is Biden going to nominate as the next chair of the Federal Reserve? The way I think about this is very simple. Right now, to say that Biden is having a rough time is a super understatement. His social spending bill is in trouble. His party just lost big in Virginia. His negotiation with Iran is going nowhere. His call to the Saudis last week to boost oil production was met by derision. And in 4 weeks' time, he's looking at another round of fiscal brinksmanship with the Republicans over the debt ceiling. I would think that he's got a very strong incentive to nominate Powell as the next chairman of Federal Reserve. If for nothing else, this will be an easy sell, to the American public. After all, Powell is a known, basically quantity represents continuity for the financial market, and financial market likes continuity. So my gut tells me that over the next couple of weeks, Biden will choose Powell. And if he were to choose Powell, I suspect we will see higher real yields, if only because I think people are going to assume that actually, Powell can now get on with the business of running this economy with too much inflation right now. The bottom line is I still think long-term real interest rates are heading higher. If I'm right, I think volatility is probably going to follow suit and move higher too. I also continue to like owning the US dollar, especially given the fact that actually the long dollar trade may be a good hedge against basically betting higher real yields, only because the recent dollar strength may be telling us that there's stronger than expected foreign demand for U.S. government bonds, especially coming from Europe and maybe even from Japan. Positioning for higher real yields is usually a trade for institutional investors. However, a number of you guys got in touch with me this week wanting to know how could a retail investor get involved. The answer is you could sell short one of the inflation index bonds ETFs, such as TIP. Of course, TIP, because it owns inflation index bonds across the entire yield curve, you'll be basically betting that real yields go up across the entire yield curve rather than just long-term basically real yields. But so be it. It's imperfect, but it's at least something if you're interested. Now, what you can see on this chart here is that I think at this point, short selling TIP means that you have relatively limited downside at this point, in my humble opinion, whereas probably the upside is about 4 to 5%. Not massive basically gains, but I think in terms of risk reward, it's attractive. And because it's a relatively low volatility trade, this means you could upsize the trade to reflect the low volatility nature of this trade. Interestingly, despite the fact that real yields went down last week, VIX actually went up last week, especially towards the end of the week. Okay. Now, however, a word of caution for those of you who are considering buying VXX, which is an ETF linked to VIX, which is the fact that for you to make money on this trade, VIX will have to go up more than what's priced into the market. For example, if you look at this chart right here, okay, currently the market is pricing, basically in 2 months' time, VIX will be at 21. In 3 months' time, it's at 23. Okay, so from that point of view, for you to make money, okay, being long VXX, you probably need VIX to start going up very, very fast within the next 2 or 3 weeks. Before we wrap it up, let's go through my honest board. My long positioning in Pfizer is doing obviously quite well, despite the fact I did not predict the news about the new antiviral drug. That said, if you look at the number of new cases globally, especially in Europe, there's no doubt in my mind that the fifth wave is unfolding as we speak. And from that point of view, I think Pfizer's stock price would have gone up with or without the antiviral basically pill. Okay, but because of the antiviral pill, I think that the stock can probably overshoot my target at 50. This is also the reason why I'm still hanging on to my stock, at least for now. Okay, for the same reason, I still like Exxon, okay, which is still basically a positive position, despite the drop in oil price this week briefly below $80 a barrel. I think that the fact that OPEC resisted American pressure to increase production is good news. I think that the Pfizer news is great news basically for oil price and therefore for oil majors, because this just means that people are going to get back to the plane, get back in the car. I think traveling is going to become it's going to basically continue to recover into 2022. So I still like owning ExxonMobil, especially as I said last week, a high dividend utility style trade, okay? I'm still short euro against the US dollar. That trade is also up. I still think that trade probably has got much more room to go, especially if I'm right about higher real yields, because guess what? The dollar absolutely loves higher real yields, okay? I entered a long 10-year basically real yield position last week at 103. I'm down obviously with the big collapse in real yields this week. I'm down about 7 basis points. I'm slightly down on my long VXX trade, although, it's pretty amazing to me how that trade, has held up so well. And then finally, my short IWM position got stopped out when small cap stocks basically went through the roof early in the week. I entered the position 220 and I got stopped out at 232. That's it from me, and talk to you next week.